Today, we're taking a journey through time to explore the major financial crises that have shaped our modern world, from the Tulip Mania of the 1600s to more recent economic disasters. These events teach us valuable lessons about human behavior, greed, and the fragility of financial systems. Drop a comment below telling me which crisis you find most interesting, or if you've experienced any of these events firsthand. Now, let's jump into our economic time machine. Our journey begins in the Dutch Golden Age with one of history's most bizarre financial bubbles, Tulip Mania. During the 1630s, tulips had recently been introduced to the Netherlands from Turkey and became a status symbol among the wealthy Dutch merchants. The flowers were beautiful, exotic, and some varieties displayed unique patterns caused by a virus, making them extremely rare and desirable. As demand for tulips grew, prices began to rise dramatically. People from all levels of society started buying tulip bulbs not to plant them, but to resell at higher prices. Futures contracts were created, allowing people to buy bulbs that hadn't even been harvested yet. At the peak of the mania, a single rare tulip bulb could cost as much as a luxurious house in Amsterdam, roughly 10 times the annual income of a skilled craftsman. The speculation became increasingly frenzied. People sold their businesses, homes, and possessions to invest in tulip bulbs. Taverns became informal trading floors where bulbs changed hands multiple times in a single day. The market was driven purely by speculation. Buyers had no intention of planting tulips, only of selling to someone else at a higher price. In February 1637, the bubble burst suddenly. During a routine bulb auction, buyers failed to appear and prices collapsed overnight. Within weeks, tulip bulbs that had been worth a fortune became nearly worthless. Fortunes were lost, contracts were broken, and the Dutch economy suffered. Tulip mania became the first recorded speculative bubble and remains a cautionary tale about irrational market behavior and the dangers of asset bubbles driven by pure speculation rather than intrinsic value. Fast forward to 1720 England, where another spectacular financial disaster unfolded, the South Sea Bubble. The South Sea Company was granted a monopoly on trade with South America by the British government. The company's directors promoted wildly optimistic projections about the potential profits from this trade, despite the fact that Spain controlled most of South America and was unlikely to allow significant British commerce. The company's stock price began to rise as investors bought shares based on these exaggerated promises. Clever marketing and rumors of immense wealth fueled speculation. The company even offered to take over Britain's national debt in exchange for more trading privileges, which seemed to legitimize the enterprise and attracted even more investors. As South Sea Company stocks soared, hundreds of other companies sprang up, offering shares in increasingly absurd ventures. These were called bubble companies, and they promised everything from extracting silver from lead to trading in human hair. One infamous company sold shares for a company for carrying out an undertaking of great advantage, but nobody to know what it is. Incredibly, people invested in these schemes. The mania reached its peak in the summer of 1720, when South Sea Company stock had risen nearly tenfold. Then reality set in. The promised profits from South American trade never materialized, and investors began to realize they'd been buying worthless paper. The stock crashed spectacularly, falling back to roughly its starting price. Thousands of investors were ruined, including many members of the aristocracy and even members of the royal family. The aftermath was devastating. Public anger was intense, and Parliament launched investigations. Several company directors were imprisoned and their assets were seized. The crisis led to the Bubble Act of 1720, which restricted the formation of joint stock companies for over a century. Sir Isaac Newton, who lost a fortune in the bubble, famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." Jumping ahead to early 20th century America, the Panic of 1907 was a financial crisis that nearly destroyed the U.S. banking system and led to the creation of the Federal Reserve. The crisis began in October 1907 when a scheme to corner the market on United Copper Company stock failed spectacularly. The collapse of this speculation attempt triggered a loss of confidence in banks and trust companies associated with the speculators. At this time, the United States had no central bank, and the money supply was relatively inflexible. When depositors panicked and rushed to withdraw their money, banks didn't have enough cash reserves to meet the demand. Bank runs spread throughout New York City and then across the country. Dozens of banks and trust companies failed as they couldn't provide cash to depositors. The stock market plummeted, losing nearly 50% of its value from the previous year's peak. Credit dried up completely, and businesses couldn't get loans to meet payroll or buy inventory. The economy entered a severe recession with rising unemployment and business failures. The crisis threatened to spiral into a complete financial collapse. J.P. Morgan, America's most powerful banker, stepped in to save the financial system. He gathered the heads of major banks in his library and essentially forced them to pool their resources to support failing institutions. Morgan himself pledged millions of his own money and convinced other wealthy individuals to do the same. He organized the rescue of several major trust companies and brokerage firms. The crisis eventually stabilized, but its impact was profound. It demonstrated the vulnerability of a banking system without a central bank to act as a lender of last resort. This led directly to the creation of the Federal Reserve System in 1913, fundamentally changing American banking. The Panic of 1907 showed that even in a modern economy, financial panics could occur with devastating speed, and that institutional safeguards were necessary to maintain stability. The Great Depression remains the most severe economic crisis in modern history. It began with the stock market crash of October 1929, when the Dow Jones Industrial Average fell nearly 25% over 2 days, known as Black Thursday and Black Tuesday. However, the crash was just the beginning of a decade-long economic catastrophe that affected the entire world. Throughout the 1920s, the U.S. stock market had experienced tremendous growth. Speculation was rampant, with people buying stocks on margin, borrowing money to purchase shares. When the market crashed, these leveraged investors were wiped out instantly. But the stock market crash alone didn't cause the depression. It was a combination of factors, including bank failures, reduced consumer spending, the Smoot-Hawley tariff that devastated international trade, and poor monetary policy. Bank runs became epidemic. Without deposit insurance, when a bank failed, depositors lost everything. This caused people to withdraw their money at the slightest rumor of trouble, which caused more banks to fail. Between 1930 and 1933, approximately 9,000 banks failed, wiping out millions of people's savings. The money supply contracted severely, making the economic situation far worse. Unemployment in the United States reached 25% at its peak, with some cities experiencing even higher rates. Millions of people lost their homes and lived in shantytowns called Hoovervilles, named after President Herbert Hoover. Bread lines stretched for blocks as hungry people waited for food. The agricultural sector suffered from both economic collapse and environmental disaster, as the Dust Bowl destroyed farmland across the Great Plains. The Depression was truly global. Germany experienced hyperinflation and economic collapse that contributed to the rise of Nazism. Britain struggled with high unemployment and social unrest. International trade collapsed by 2/3. The economic suffering contributed to political extremism and ultimately to World War II. Recovery was slow and painful. President Franklin Roosevelt's New Deal programs provided relief and reform to the financial system, creating institutions like the FDIC to ensure deposits and the SEC to regulate securities markets. However, full economic recovery didn't occur until World War II dramatically increased government spending and industrial production. The Great Depression reshaped economic thinking and led to the development of Keynesian economics and modern macroeconomic policy. On October 19, 1987, stock markets around the world crashed in what became known as Black Monday. The Dow Jones Industrial Average fell 22.6% in a single day, the largest one-day percentage decline in stock market history. The crash was sudden, unexpected, and spread globally with terrifying speed as markets in Asia, Europe, and the Americas all plummeted. Unlike previous crashes, Black Monday wasn't preceded by obvious economic problems. The economy was growing, unemployment was relatively low, and corporate profits were strong. However, several factors contributed to the crash. Stock valuations had risen significantly and were considered overpriced by many analysts. The U.S. dollar had been weakening, and there were concerns about trade deficits and rising interest rates. A key factor was the relatively new phenomenon of computerized trading. Program trading and portfolio insurance strategies meant that computers automatically sold stocks when prices fell, creating a feedback loop. As prices dropped, computers triggered more selling, which pushed prices down further, triggering even more automated selling. This technological amplification turned what might have been a normal market correction into a catastrophic crash. The crash began in Hong Kong, spread to Europe, and hit the United States with full force. At the New York Stock Exchange, the volume of sell orders overwhelmed the system. Some stocks couldn't trade because there were no buyers at any price. Traders watched in horror as decades of gains evaporated in hours. The total loss in market value exceeded $1 trillion globally. However, the aftermath of Black Monday was surprisingly different from previous crashes. The Federal Reserve, led by Chairman Alan Greenspan, who had been in office for only 2 months, acted decisively. The Fed immediately issued a statement affirming its readiness to provide liquidity to support the financial system. Interest rates were lowered, and banks were encouraged to lend. Remarkably, the crash didn't trigger a recession. The economy continued growing, and the stock market recovered relatively quickly. Within 2 years, the market had regained all its losses. Black Monday led to important reforms, including circuit breakers that temporarily halt trading if markets fall too quickly, giving people time to assess situations rationally rather than panic. The crisis demonstrated that swift, decisive action by central banks could prevent market crashes from becoming economic disasters. The Asian financial crisis began in July 1997 when Thailand was forced to devalue its currency, the baht, after running out of foreign exchange reserves. This seemingly regional problem quickly spread throughout East and Southeast Asia, becoming one of the most severe financial crises of the late 20th century and shattering the myth of the Asian economic miracle. During the 1990s, Asian economies had experienced remarkable growth. Countries like Thailand, Indonesia, South Korea, and Malaysia were called Asian tigers, attracting massive foreign investment. However, this growth masked serious problems, including excessive borrowing in foreign currencies, real estate bubbles, and close relationships between governments and businesses that led to poor lending decisions and corruption. Many Asian countries had pegged their currencies to the U.S. dollar, which worked well when the dollar was weak, but created problems as it strengthened in the mid-1990s. Their exports became expensive and uncompetitive. Companies and banks had borrowed heavily in dollars, and when local currencies were devalued, the real burden of these debts skyrocketed. The crisis spread like wildfire.
Indonesia's rupiah lost 80% of its value. The Thai baht, Philippine peso, Malaysian ringgit, and South Korean won all plummeted. Stock markets crashed across the region. Banks collapsed as loans went bad and depositors panicked. Companies went bankrupt, unable to repay foreign currency debts. Unemployment soared and poverty increased dramatically. The social and political consequences were severe. In Indonesia, economic collapse contributed to riots and the end of President Suharto's 32-year regime. Thailand and South Korea had to accept humiliating bailouts from the International Monetary Fund, with strict conditions requiring economic reforms. The crisis eventually passed and Asian economies recovered, but the experience left lasting scars and led to changes in how these countries managed their economies, including building up large foreign exchange reserves to protect against future currency crises.
As the Internet revolutionized communications and commerce in the 1990s, investors became convinced that traditional business rules no longer applied. The dot-com bubble was a speculative mania focused on Internet-based companies that reached its peak in March 2000 before spectacularly collapsing. During the late 1990s, simply adding .com to a company name could send its stock price soaring. Venture capitalists poured money into Internet startups with little or no revenue, let alone profits. The prevailing wisdom was to get big fast, focus on growth and market share while ignoring profitability. Companies spent lavishly on advertising, parties, and luxurious offices. Initial public offerings, IPOs, of Internet companies would see stock prices double or triple on the first day of trading. The Nasdaq Composite Index, heavy with technology stocks, rose from below 1,000 in 1995 to a peak of 5,048 in March 2000, a five-fold increase in 5 years. Companies with no viable business model achieved billion-dollar valuations. Pets.com, which sold pet supplies online at a loss, spent millions on a Super Bowl commercial before collapsing. Webvan raised hundreds of millions to deliver groceries, but failed within 2 years. Investors ignored traditional valuation metrics. Companies were valued based on eyeballs, website visitors, or page views, rather than revenue or profits. The assumption was that Internet companies would eventually dominate all commerce, and traditional businesses would become obsolete. Even skeptics were afraid of missing out on the new economy. The bubble burst in March 2000 when the Nasdaq peaked and began falling. As stock prices declined, funding dried up. Internet companies that had been burning through cash suddenly couldn't raise more money. Dot-com failures accelerated throughout 2000 and 2001. By October 2002, the Nasdaq had fallen 78% from its peak, wiping out $5 trillion in market value. Thousands of Internet companies failed, and hundreds of thousands of workers lost their jobs. The collapse contributed to a mild recession in 2001. However, the Internet itself continued to grow and transform the economy. Some companies, like Amazon and eBay, survived and thrived. The lesson wasn't that the Internet was unimportant, but that fundamental business principles still mattered. Companies needed sustainable business models, not just good websites. The dot-com bubble demonstrated that new technology, no matter how revolutionary, doesn't exempt investments from rational valuation. The global financial crisis of 2007 to 2009 was the worst economic disaster since the Great Depression, threatening the entire global financial system and triggering a severe worldwide recession. The crisis originated in the U.S. housing market, but quickly spread to become a truly global catastrophe that reshaped banking, regulation, and economic policy. The seeds were planted during the early 2000s when housing prices soared and lending standards deteriorated dramatically. Banks issued subprime mortgages to borrowers with poor credit and insufficient income. These risky loans were packaged into complex securities called mortgage-backed securities and collateralized debt obligations, then sold to investors worldwide. Rating agencies gave these securities high ratings despite their underlying risk, and financial institutions around the world loaded up on what they thought were safe investments. The housing bubble peaked in 2006, and prices began falling. Homeowners with adjustable-rate mortgages saw their payments skyrocket when teaser rates expired. Defaults and foreclosures surged. The securities backed by these mortgages plummeted in value, and financial institutions holding them faced massive losses. Bear Stearns collapsed and was sold to J.P. Morgan Chase in an emergency rescue orchestrated by the Federal Reserve. The crisis reached its climax in September. Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy on September 15, the largest bankruptcy in U.S. history. The government decided not to bail out Lehman, sending shockwaves through global markets. The same week, Merrill Lynch was emergency sold to Bank of America, and insurance giant AIG received an $85 billion government bailout that eventually grew to $182 billion. Credit markets froze completely as banks stopped lending to each other, unsure who might fail next. The stock market crashed, with the Dow Jones falling from over 14,000 in 2007 to below 6,600 in March 2009. Trillions of dollars in wealth evaporated. The real economy collapsed as businesses couldn't get credit. Unemployment in the U.S. reached 10%, and millions of people lost their homes to foreclosure. Governments worldwide launched unprecedented interventions. The U.S. Congress passed the $700 billion Troubled Asset Relief Program to bail out banks. The Federal Reserve slashed interest rates to near zero and implemented quantitative easing, buying trillions in securities. Central banks globally coordinated emergency responses. Despite these measures, the world entered the Great Recession, the worst economic downturn since the 1930s. The crisis exposed fundamental problems in the financial system, including excessive leverage, inadequate regulation, perverse incentives that rewarded short-term risk-taking, and the too-big-to-fail problem, where massive institutions had to be rescued to prevent system collapse. The response included the Dodd-Frank Act, the most comprehensive financial regulation reform since the Great Depression, implementing stricter capital requirements, stress tests, and the creation of the Consumer Financial Protection Bureau. The long-term impacts were profound. Trust in financial institutions plummeted. Economic inequality widened as asset owners recovered while workers faced stagnant wages. Millions lost their homes, and an entire generation's economic prospects were damaged. The crisis's effects rippled for years, influencing everything from political movements to monetary policy. It demonstrated that despite decades of advancement since the Great Depression, the financial system remained vulnerable to catastrophic failure when speculation, leverage, and inadequate oversight combined. The lessons of 2008 continue shaping economic policy and financial regulation today. Looking at these historical crises spanning 4 centuries, we can identify common patterns. Every crisis involved excessive speculation driven by the belief that this time is different. Whether Tulips, South Sea Company stock, real estate, or complex financial derivatives, people convinced themselves that prices would keep rising forever based on some new paradigm. Leverage and debt amplify both booms and busts. When people borrow money to invest, gains are magnified on the way up, but losses are catastrophic on the way down. Many of these crises were worsened by excessive borrowing. Panic and herd behavior turn market corrections into crashes. When everyone tries to sell simultaneously, prices collapse. We've also learned the importance of financial regulation and central banks. The creation of the Federal Reserve after 1907,
deposit insurance after the Great Depression, circuit breakers after Black Monday, and Dodd-Frank after 2008 all represented attempts to prevent or mitigate future crises. However, regulations often lag behind financial innovation, and new types of crises emerge. Perhaps most importantly, these crises teach us humility. Despite all our economic knowledge and sophisticated financial tools, markets are still driven by human psychology, fear and greed, optimism and panic. Understanding history doesn't make us immune to future crises, but it can help us recognize warning signs and respond more effectively. Each generation seems to need to learn these lessons anew. As we face modern challenges from cryptocurrency volatility to concerns about asset bubbles, the wisdom gained from past crises remains relevant. Before you go, I really want to hear your thoughts. Which of these historical crises surprised you the most? Do you see parallels between these past crises and today's financial markets? Did you or your family experience the 2008 crisis, and how did it affect you? Are there warning signs we should be watching? Drop your answers in the comments section below. I read every single one and love hearing your perspectives. If you found this historical journey through financial disasters educational, please give this video a thumbs up and share it with anyone interested in economics or history. And don't forget to subscribe to the channel and smash that notification bell so you're always updated when we post new content exploring the fascinating world of economics and finance. Thanks so much for watching, and I'll see you in the next video where we continue exploring the forces that shape our world.